All right, guys. Hey, thanks. Welcome back. This is the Co-Travel Podcast with Bob Piercy. And today I'm joined again with my very first guest when we started doing this kind of series back in March, Rob Campbell, Richardson Wealth, formerly Richardson GMP. But hey, Rob, thanks for jumping on and doing this again.
My pleasure, Bob. I'm looking forward to it. I didn't realize I was the first. I'm like a founding father. Do you have a Mount Rushmore in your room or something?
The monument is being
series.
constructed. Yeah, all spots aren't taken. There's still a few open spots for people that are going to be late entries into who this is. But
cool. Thank you.
I will let you know you were off to an early lead in regards to guests. We did kind of two back to back. But then Chris Nicholson, another Henry Schein employee, he works with our special brands, exclusive brands. He's out in Ontario. He's actually been the most frequent guest to date. But then I've got more people booked throughout the year. So, the race is on, and there's
I've got some catching up to do I?
Yeah, you're early lead. You kind of fell back, but we're pushing forward. It's the next leg of the race, and hey, I'm challenging everybody to let's get on here as much as we can. Let's bring the best information and entertaining and fun information that we can, and let's make it worthwhile. So the more good stuff you have to talk about that we want to discuss, let's just keep doing it. But hey, again, thanks for doing this again.
My pleasure. Thanks. Yeah, no, and I think we got lots of interesting stuff to cover today. So it should be good.
And first of all, real quick, we're right now. It's early, kind of mid-February. You're doing well. Your family's doing well. Kind of Christmas, holidays, all that's been going as best can be expected.
Yeah, obviously it was a little quieter and somewhat strange Christmas, but everyone's healthy and doing well, so nothing to complain about. And the whole sort of remote work environment is starting to feel normal. It's been so long. So,
I know,
but it's kind of feeling like business as usual for us in spite of the COVID challenges.
Well, that's good, and that's obviously and also reassuring for people like me, who's we're trusting you with our money, and you're taking care of that and that end. So I'm glad business is booming for you and doing well. I hope it continues. Now, hey, through the conversations that we've had, and I really do value the time together, and I value this time that we're spending now as well. But you're always kind of giving interesting ideas, new perspectives, and things that I know absolutely nothing about. And one of the things we kind of were discussing that you thought would be an interesting topic is SPACs. Now, I'd never heard of this before. So really, what is it? How new is this? And what's the opportunity that we're discussing here? SPACs.
You bet. Yeah. So SPACs, and the reason I thought this was interesting is because it is starting to get some notice and uptake in the financial press. And I'll get into what SPACs are in a moment and how they work. But what's fascinating with SPACs is a lot of people are talking about the risk in them and whether there's a bubble right now. And it's interesting when you look at the SPAC marketplace, they can be actually a really good tool for generating positive returns while protecting your downside. Or they can also be a tool to put yourself in a really high risk situation with a ton of downside. So given the multiple ways that SPACs are kind of utilized and the general sort of lack of understanding around them, I thought it would be great to just kind of describe what a SPAC is, how it works, and why we think it can be a really effective tool if you're mindful of the hazards involved.
Absolutely. And I guess my first question, I know people that aren't familiar, is, it's an acronym. So what does SPAC stand for? And interesting. So you just said, if I'm recapping properly, there's a great opportunity to maximize gains, minimize risk, but if done incorrectly, you're basically opening yourself up to the complete inverse, where it's like low risk and high risk. Sorry, low gains and high risk.
Yeah. Yeah, that's mostly correct.
If you correct me all you want. You're the expert here.
Yeah, when you add the risk, you're kind of adding. You're not eliminating the upside possibility, but you can bring in some significant downside risk as well. What we specialize in doing is utilizing SPACs where we're almost eliminating or at least minimizing downside risk while still capturing a really good portion of the upside. But maybe we should just start with what SPAC stands for and what they are. So a SPAC is an acronym that stands for Special Purpose Acquisition Corporation. And just to describe how it works, and I'll just kind of walk you through almost a scenario. So
yeah, please.
What will happen is there will be a highly respected management team that's proven themselves successful in managing businesses, perhaps in a certain industry or area. And this management team will go out and raise a large amount of capital. So think in terms of like 100 million, 200 million, $300 million. So that they're raising a significant
So you're
amount
walking
of
around
capital.
money is what you're telling me, right?
Yeah,
Like,
yeah, I
what's
wish.
in the back pocket?
I wish. Yeah. So they raised 200 or 300 million. Now, in order to do this, there's kind of two aspects to that raise. So the sponsor team, and these things are backed by people like Goldman Sachs or Blackstone Group, or rock star executive teams in the corporate world, they put in often 10 to 20 million of their own money. So these are really well-heeled individuals. Now, their money in looks after all the costs of operating the SPAC. And then arm's length individuals like ourselves and our clients, we put in the balance of the 200 or 300 million in a trust structure. So we like to invest in SPACs at their initial offering, and SPACs are always issued at $10 a share. So we buy our unit of the SPAC at $10, and that money goes into trust where we know we're going to get that money back should we choose to later. And that'll become clear in a moment. So big pool of capital comes in. Now, the whole objective of the SPAC is to go out and find a large private business that wants to be public. And I should mention that. So the SPAC, some people call it a blank check company, or other terms I've heard as a blind pool. What the SPAC is it's actually traded on the exchange. So they raise a bunch of money at $10 a share, and then it basically just trades at $10 a share because it's just a pool of capital with a trust agreement in place. But that executive team that raised the money, they then have a 2-year window to go out and find a private company that wants to go public. So you've kind of got the SPAC, which is the public company framework with a bunch of money in it, out there looking for a private business that isn't public yet that wants to go public. And what happens is when they identify that opportunity, they negotiate a transaction where the private company merges into the SPAC and it becomes public. So it's a tool that's used to take companies public, and it's been very popular right now with the excitement in markets around bringing companies public. Does that make sense?
I think so. For my novice investing mind, I think it does make sense. So now this is something you guys are obviously are backing, and you guys are investing in, and you are promoting. And one thing we've talked about in the past too is just something kind of special with Richardson is regards to your fiduciary responsibility.
Yeah, you know what, Bob? Why don't we circle back to that if you don't mind? So I can just finish off how the SPAC works and where the opportunity is. Then I'm happy to chat about that a little bit more. So just to kind of walk somebody through the piece. So, and a couple of good examples that we've seen in recent months were when you heard about Nikola, an electronic vehicle company going public, or Virgin Galactic, Richard Branson's firm, or DraftKings. So what happens is, if that SPAC management team is fortunate enough to identify a private company like DraftKings that everybody loves, well, when they announce that deal, that SPAC goes up significantly on the deal announcement. Now, the beauty of the SPAC structure, so what I'd like to take you through is both how we use it and where the risk comes in. Okay, so when we buy that SPAC at $10 a unit, it's trading at $9.90 to $10.10. And then when they announce the deal within the 2-year window they have to do so, we have a couple of different options. So option one for us is, if we don't like the deal, we can simply ask for our money back with T-bill interest. So that's option A. So worst case scenario, you get your money back with T-bill interest. Option B would be to sell the SPAC when the deal's announced. Now, often when something like DraftKings or Nikola was announced, that SPAC might go from $10 to $14 on the day of the announcement. And so option number 2 is to sell into the excitement around the deal and lock in that gain. Now, option number 3, which we never do, would be to continue to hold on to DraftKings once it rolls into the business. So for the first 2 years, you have no downside risk and no business risk, because it's simply a financial structure with a guarantee. The moment the deal is consummated, you have all the potential downside of owning the latest, greatest IPO that everyone's fallen in love with. And certainly that stock might do really well and go up incrementally further. But when we have the opportunity, we're happy to lock in that big pop on the announcement and get out. So the way we use SPACs is we never own them past the deal consummation. So your worst case scenario is getting your money back with T-bill interest. But if 1 out of 3 or 1 out of 4 or 1 out of 5 is really well received, then you can lock in some upside on that.
Okay, so first of all, thank you very much, because you just asked or answered the question that I should have asked after your initial. It's like, give me an example of a SPAC. And so, like you say, Nikola and DraftKings are 2 companies that were private, that were used, and they used the SPAC process to bring it to market.
Exactly. Now, there's a couple of other nuances as well that I might share. And so it was really, so like to touch on a couple things. So first of all, one nuance, this might be more depth than we want to get into, but when you buy that unit at $10 a share, you also will often get a warrant to buy more in the future, for example, at $11.50. So the SPAC comes out at 10, you buy your unit at 10, and you get a warrant to buy more at $11.50. Well, that warrant is risk-free upside, because if the deal is announced and the SPAC price doesn't go anywhere, then your warrant is just going to expire worthless. But if it merges into DraftKings and DraftKings goes to 14 or 15 or 17, you can buy more at $11.50 and turn around and sell it at 14, but you're not committed to putting that capital in. So again, it's a really interesting asymmetric return opportunity, because you get equity upside, often significant equity upside, with limited downside. Now, the other nuance to be mindful of, though, is this has been a really wild ride the last year or 18 months in the SPAC market for a couple of reasons. So first of all, as we're all well aware, COVID hit in March, and we saw this massive, surprise, surprise, it impacted the stock markets, Bob.
Where was I?
But what we saw at the height of COVID, whether due to panic because what was happening in the world, or the tremendous need for liquidity, and I'm sure many of your clients experienced this, where you weren't sure when you're going to be able to reopen your business. Many people were raising capital wherever they could, and often reaching into their public market stocks to sell. So what we saw was even SPACs that have a guaranteed $10 unit value, people were rushing to sell them just because they needed the money. So we saw SPACs with a $10 guarantee trading at $9.50, $9.30, $9. And it was a tremendous opportunity, because if you have the 2-year window, if you buy that SPAC at $9.30, the worst that's going to happen is you're going to get your $10 back when the deal is announced at the end of that 2 years. So, but the reality is, because SPACs are publicly traded, even though you have a guarantee, they can move around a little bit. So in normal market conditions, they might trade between $9.90 and $10.10, but because of that COVID sell-off, they came off a little bit more. So if you had a portfolio of SPACs, even though your money's guaranteed, you're still going to see it pull back or reduce a little in your statements. But subsequent to COVID, we've seen a couple of things. Most people have got control of their liquidity. Central banks around the world have been pumping liquidity into the marketplace. And as a result, we've seen real strength in financial markets, to the point where there's a bit of euphoria, might be too strong a term, but there's a lot of excitement in a bunch of different industries around taking companies public. We've already talked about sort of alternative energy or electric vehicle companies, gaming companies, cannabis. So there's all sorts of excitement around these public market transactions. And subsequent to that, 2020 turned out to be just a phenomenal year for SPACs, because earlier in the year, we were able to buy them at discounts to their guaranteed value. And then where I mentioned that, the expectation might be 1 out of 3 or 4 or 5 of these things that really pops in the deal announcement. Well, there's been a lot more deals, a lot more excitement around them. And so, lately it's been 1 out of 2 or 1 out of 3 that are really generating some excitement, and we're able to sell it at 13 or 14 on that $10 trust value.
How long have SPACs been available for investment opportunities to the public? Has this
For
been
many years, 5 years for sure, probably beyond that. And I'm not sure if the name had changed, but I've seen market data, for example, from one of the strategies that we partner with, analyzing returns over the last 5 years of the SPAC market. But typically, when we're buying SPACs, over a portfolio of SPACs, our goal would be to generate in any given year maybe a high single-digit return or a low double-digit return,
right?
With minimal downside risk. And to us, that's great. If we can get 8 or 10% where we've got some downside protection and some guarantees, that's wonderful. But between being able to buy SPACs at discounts during COVID and the kind of red hot, call it an IPO market, even though they're not technically IPOs, a lot of our SPAC strategies were returning, one was north of 60% last year, one was in the 40% range. So just tremendous returns from what we were sort of buying as a low risk strategy. Now, actually, that probably leads us into the second reason I wanted to talk about SPACs.
Please.
Sorry to cut you off there,
Hey,
Bob,
this is great, man. You're making my job easy for me. So let's just keep going. Yeah.
Now, so the question is, if you have an eye on the financial press today, people are talking about the bubble in SPACs. And there's been all this money. So now people are excited to own SPACs. So there's a whole bunch of money going into these SPACs. So, 18 months ago, if there was maybe 20 SPACs on the market that had raised somewhere between 30 and 50 million each, well, today there might be 40 SPACs on the market and they're raising 300 million each. So
they're all searching for those companies that they want to help go public. So
exactly, they're all searching for companies, but there's been a lot more capital coming in because people are excited about these returns. So that brings up the question of risk. Now, where the real risk resides is as you've got more capital chasing companies to take them public. Well, it's a law of supply and demand in economics. Inevitably, as they search harder and harder for companies to take public, you run the risk that the quality of those companies that are going public is going to diminish. Or perhaps they're just not in the proper spot in their life cycle yet that they should be going public, but there's so many SPAC dollars chasing deals that you and your buddies might have a private company that has no business being public, but maybe a SPAC's willing to take a chance on you because they've got tens of millions of dollars burning a hole in their pocket. Secondly, on these announcements, we're seeing such big moves that when people talk about a SPAC bubble, there's some real truth to that. And if you were the person always showing up after the deal announcement and buying DraftKings and Nikola or Virgin Galactic after it had already moved up, well, you've got all the downside risk of that business. So you have to be very careful. You understand the true value and whether it's profitable or not. Similarly, if you're throwing money into SPACs and holding them through the deal, even if you don't know the businesses, you got a lot of downside risk. Where that comment about a bubble in the SPAC market or a high risk of loss is inaccurate is if you're smart about it, and if you buy SPACs on the initial offering or prior to the deal announcement, and you buy them at that $10 guaranteed trust value. And if you always either take your money back with T-bill interest or sell on deal announcement, there is no downside risk to you, regardless of how much money flows in and how excited people are about them. Your downside protection is to just ask for your money back or sell into the market prior to the deal.
Wow.
So I covered a lot there, Bob.
No, you did. And it's great. It's interesting. And it's kind of going back, like you said, so this kind of investment format's been available for 5 years, which, I'm assuming in the investment world, that still is a very short period of time.
It is. Yeah. I think it actually probably goes back a decade or two, but I just don't want to say anything inaccurate. And I know I've got seen strategies with over 5 years of track record investing in them.
No, fair enough. But again, at the same time, it's not as when people generally think about investing, they're talking about, buying stocks on the market. They're talking about investing in funds or indexes. These are common, street level types of investing strategies where, again, I've never discussed or heard of SPACs before. So it has to be, it is a newer form in regards to more traditional types of investing. And it's obviously appealing, because again, the way you talk about it, you invest for $10 a share. Worst case scenario, you kind of get your money back, or you get it at T-bill rate, I think you said.
T-bill interest, yeah.
Thank you. So there's a minor gain there, but again, you're really waiting for this fund to find that next company to go public. Now, I guess you do talk about the bubble, and the bubble is concerning, I guess, or you want to be aware of it and I guess, how does your company navigate that bubble concern versus because if it's a traded quantity on I could buy it personally. So I guess, how do you guys search out and decide which stacks to invest in versus others, and how do you mitigate that bubble risk?
You bet. That's a really good question, Bob. And that actually probably dovetails back to your prior question. So why don't I answer the one about our fiduciary approach and then come back to that, because it sort of fits nicely with it. Yeah, so my team at Richardson Wealth, we manage wealth for our clients, working with them to achieve financial independence. We take a holistic approach, looking after not only wealth planning, but also managing the investment portfolios of our clients. But our firm is unique in that we have our fiduciary designation, which means that we're in a trusted advisory position where we're never in a conflict of interest. And our firm has been recognized by an organization called CFIX, the Center for Fiduciary Excellence. And as a result, there's a number of checks and balances and audit procedures that we're subject to ensure that when we're investing our clients' money, there's never any sort of hidden costs. We're not in a conflict of interest. We're not getting paid on the back end or anything like that. So that's what that fiduciary designation that Richardson Wealth holds means. And we're very, very proud of that fact. Now, in terms of how, and that kind of leads into, I guess, how our team here in Edmonton, Campbell Wealth Management, sort of approaches and utilizes that, is one of the mantras that we operate by is we try to bring an institutional approach to personal wealth management. And what I mean by that is, when you look at the type of investors that are the most disciplined, the least emotional, that make the most rational decisions, it tends to be institutions. We try to bring that type of approach to people like you and Kat and many of your clients. Now, one of the ways we do that is by looking at the type of investing that institutions do and modeling our process on that. One of the areas that institutions are far and away ahead of retail investors is embracing alternative investments and alternative strategies. And SPACs are one of those, where institutions for many years have been going further afield than individual investors, trying to move away from traditional stock and bonds to source opportunities where you can get better risk-adjusted returns. And that's kind of a cliche term, but effectively that's what we're talking about here, trying to achieve in the SPAC market. We want to achieve good upside with minimal or no downside. So that's a good risk-adjusted return for us. So step one in terms of why we're utilizing these things is that institutional approach. Now, the second thing we do, and again, modeled on institutions, is, even my mom would know this one. You want to be careful about putting all of your eggs in one basket. And so when it comes to individual SPACs, we typically don't go out and select and buy individual SPACs. Instead, we use and partner with 2 or 3 strategies that have been managing in the SPAC market for years, that have an understanding of evaluating the management teams that are coming to the market, that are good at identifying and buying those SPACs at $10 a unit. And by doing that, within each of the strategies we own, we might own 10 or 15 or 20 SPACs, which reduces our risk and diversifies it away. And then we use 2 or 3 different managers. Some of them will keep the warrants, some of them will sell the warrants to reduce their costs. There are some different nuances in the approach. There's probably a depth we don't want to get into here. But,
but also in short too, because of the fiduciary responsibility you guys have, like your money is invested in this same product as well. And so really we're all doing, you're doing what's best for yourself, which is again is doing what's best for your clients, as opposed to other investment houses or firms where again, like there could be a spiff or a sales promotion to sell a certain package or a certain bundle where they make money regardless of the return on the actual investment.
Yeah, there's kind of a couple of different things you've raised that are buried in there, and I don't want to, paint with broad strokes about our
Right.
competitors or other people out there in the market. But what I can tell you what that means to us now, in terms of us investing alongside our clients, we do that, and we like to say we eat our own cooking. So I own the same things that my clients do, but that does not qualify me as a fiduciary. So, there might be competitors out there that are not fiduciaries that are still investing in similar things. The important thing to designate us as a fiduciary is that we get paid the same, whether we're directing a person to invest in strategy X, strategy Y, or strategy Z. Our clients know exactly what we're being paid, so it's transparent, and we're not, our compensation doesn't tilt us or cause us to favor one solution over another. So that's really more the integral part of maintaining that fiduciary designation and responsibility versus whether or not I happen to be investing alongside it, if that makes sense.
No, yeah, you did a much better job of explaining it than I think I did, which is good that you should be able to. And so again, yeah, this SPAC plan program sounds obviously very interesting. And I guess what's kind of, is there really a loss in doing this, or is like the worst case scenario is really you get your money back because that fund isn't able to find a company to invest in within 2 years, and then you're really left at where you started?
Yeah, yeah. If you do it right, and if you're paying attention, so if you're able to source and buy the SPAC on the new issue, you have that opportunity to have the guaranteed funds. If you buy the SPAC in the aftermarket, you have to be careful that if that guarantee is at 10 and you go out and buy the SPAC at 11 or 12, you're only guaranteed on 10, not on 11 or 12. And you are absolutely correct that if you do it appropriately, you can completely mitigate your downside risk. But there's a couple of things to be aware of. So over the 2-year window where that management team is looking for a business, that SPAC will move around. And COVID's a great example. If you bought a SPAC at $10 a unit, but in the midst of COVID, you need to sell it and it's trading at $9 a share, your guarantee is no good until those 2 years are up or until the deal is announced. So you have to be cognizant of having the liquidity to wait out the 2-year guarantee. So it's not just like you can pull the trigger on any day and say, I want my money back. You have to be prepared to hold the 2 years if needed to achieve the guarantee on it.
Well, I think that just comes back into like the investment strategy that you have with your clients, and I know the conversations that we've had about our investments, I'm assuming they're very similar with other clients too, is just, kind of making a plan. What is the long range plan? Are you going to need money in the next 2, 3, 5, 10 years? Can we let this sit into it? Can we commit this money to 2 years in hopes of a larger return, or, do you need to be more liquid for another reason? And then, so that goes into the investment strategy you have. Obviously, COVID was a big, unexpected, unforeseen, circumstance people had to deal with, and you're right. I think a lot of people had to make changes to their investment strategy to access funds just to keep the doors open, and that's dental offices, that's restaurants, that's other businesses that were obviously basically everyone who's affected by it. I'm sure, and like you said, it was shown in the market where the SPAC prices dropped because people needed liquidity, sooner than they realized.
Yeah. Actually, Bob, that could I just comment on,
Please, yeah.
What you brought up there? Yeah, and what you were referencing, that whole challenge of balancing liquidity. So it's important in conversations like this that we might talk about an investment that sounds wonderful, but it's not always going to be right for everybody. And it's important for your listeners to know that today and in the future, when we're talking about stuff, hopefully we pique their curiosity. Hopefully they're interested in speaking with me and my team. But a big part of what we do is understanding the financial position and situation of our clients, what their goals and objectives are, what their risks are, what their business entails. And one of the elements that we have to customize solutions and tailor them to all of that is the need for liquidity and potential need for liquidity. The reason I bring that up is you'll recall one of our earlier conversations was around alternative investments. And I would categorize SPACs as alternative investments. And with a lot of these different alternatives, again, these are the types of strategies that institutions use. You tend to have to make a sacrifice. So in the world, as you know, there's never a free lunch. You know, if things sound great, you're always giving something up. Well, in the investment world, you're really always looking for three things from an investment. You're looking for a high return, you're looking for low volatility or stability, effectively. So you want a high return, you want stability, and then you also want liquidity. In a perfect world, you'd be able to get your money out tomorrow if you needed it. Now, the fact of the matter is, with a lot of these alternative investments, what we found is if you give up a little bit of liquidity, like we're talking about with SPACs, then you can significantly increase your return and you can significantly enhance your stability. But it's important to understand how much liquidity are you giving up across your portfolio, and what can you withstand in a doomsday scenario like COVID, and certainly I don't mean to be facetious or make light of the issues around it. And for some businesses, it really was a doomsday scenario, depending on what business you're in. And so we always have to be engaged with our clients and ensuring that hopefully we're giving up a little bit of liquidity in order to generate stronger and more predictable returns. But at the same time, we have to ensure that we're always mindful of what's going on in their lives, potential risks in their business, so that we've got enough liquidity that if we need something to sell really fast, hopefully we're not selling a SPAC with a $10 guarantee at $9.30 a share because we need the cash tomorrow. So
right, yeah, no, absolutely. Now, one thing that's kind of been in the news, and if you're cool stepping away from SPACs right now,
you bet.
Robinhood, GameStop, the whole, the big, bad venture capital investors that are taking advantage of the little guy. Like, what's your perspective on this? Because right now it's kind of passed a little bit, but it was big news for a couple of weeks as this was happening. Is this showing something about the market that we didn't realize or didn't know about, or are we finally getting to a look behind the curtain of what's actually happening in this investment world?
It's fascinating because there's so much going on and there's a lot of different layers to that story. But to the start of your question, or is it something new, or are you getting an insight? It's funny because for years, as your guests will probably figure out, I'm here in Edmonton, and Alberta has long been home of junior mining companies forever. And Vancouver truly is the home of junior mining today. But it's with mining investments, there's an old phrase that had been around for years. And if you ever remember the Briac story or watched the gold movie about it with Matthew McConaughey, It's called the pump and dump. And so you find a really illiquid company or security, you start spreading the word about how wonderful it is and it's going to go up. Because it's got such a small float and so illiquid, money starts flowing into it. And generally the people that started the pump and dump are the ones that sell at the top. Well, the word is spread far enough that others are still buying. And so as you know, I'm not super engaged in social media, and I certainly haven't done a deep dive on Reddit. But to me, this sounds an awful lot like a pump and dump, however you want to justify it being, taken on the man or taken on Wall Street or what have you. So in terms of, is this type of thing new? No, it's been happening for years and years and years and years and years in one form or another. A really interesting facet to this is how they've identified companies with a short position, though. And that might be something interesting for us to talk about, because your listeners might have heard that term, but they might not be familiar with how it works and why it's salient within the whole sort of Reddit story.
Okay, please
it makes sense to talk about that. So the idea of taking a short position or short selling is that you've identified a company that you think is overvalued and you want to profit from it going down. And now how that works, the mechanics of it, it's really easy to kind of remember and understand because it's the same thing you always want to do when you invest. Again, even my mom knows this one. The idea is to buy low and sell high. We always want to do that whenever we invest, right? Now, what a short sell does, though, is it simply reverses the order of the buying and selling. So what you do when you short sell is you borrow that stock from someone like your brokerage firm, you sell it, you receive the proceeds from that sale into your account, and then at a later date, you're going to have to buy back that stock in the market and give the stock back to repay the loan. So the idea is you sell it here, buy it back at a future date here, and keep the spread just like you would in a normal transaction. You want to buy low and sell high, you're just selling first. Now, what people may not understand is we're hearing the term short squeeze, and what does that mean? And actually, before I get to short squeeze, there's something really important to understand about short selling, because even if I had a client come to me and was convinced that they'd identified a dog of a company that was going to go down, or had a strong view on a commodity that was going south or something like that, I always try to talk people out of short selling. And there's a very fundamental reason why. So if you came to me, Bob, with some fantastic idea of some company you've identified,
Tesla's going down, man. It's way overvalued.
No, but let's do the opposite first. Let's say you found a company you really thought was going to go up. I thought it was a bad idea, but you said, Rob, I'm going to put $100 into it. Well, the worst that can happen if I don't talk you out of buying that company is you're going to lose your $100.
Right.
That $100 company goes to zero. You walk away with zero. The problem with short selling is if you come to me with this, high conviction that you think this particular company is going to fall, and you want to short it. Let's say it's a $100 company and you short it at 100. Well, if that $100 company goes to 200, you've just lost all your money. But if it goes to 400 and you now have to buy it back in order to repay the loan of that stock, you've just lost 3 times your money. If it goes to 1,000, you've lost 10 times your money. So when you short something, your losses are potentially unlimited. And so if you short something that's going up in value, your losses are accruing without limit. Now, why that's important is circling back to brokerage firms. So if you were trying to short sell something, or if you're a hedge fund manager or one of the big bad guys on Wall Street, like the Reddit people are talking about, they borrow the position they're shorting from one of the firms they're working with. Then what happens is if the price of that stock starts to go up, everyone gets worried that they're not going to be able to afford to buy it back and repay the loan. So they then start giving what's called margin calls. So if you're short a position and that stock is going up in price, your brokerage firm is going to make you deposit more money in your account to ensure that you have the money to cover it. So if you're still convinced it's going to go down at some point, then you'll try and post more money. The problem is, though, eventually you might run out of money to post or run out of conviction. And then the only way to close out that trade is to buy it back. So you were short a company you thought was terrible at $100 a share. Let's say it's gone all the way to $300 a share and you've run out of money you can put in for your margin calls. So you've then got to buy it back. Well, you're now the person buying at 300, driving it even further. So that's what creates the short squeeze is, a crowd of people on Reddit or wherever can get a group to start buying a thinly traded, even if it's a junky stock, start driving it up. But then it puts pressure on short sellers to start having to close out their positions. And as they do, it drives it up even further. So it's sort of really interesting financial engineering behind it that really accelerated that move up in a company like GameStop. And then once the trend reverses, it comes down just as quick. So
now it's been about a week or two since this was really front and center in front of us. And it seemed to me though that if I remember correctly, I think the Reddit people figured out that these investment firms had oversold it, overshorted like 140% or something. So there's a massive um, downward pressure on the stock, and then they were able to they started buying shares at pennies on the dollar because it was so cheap. And again, like you say, the investment firms needed to make good on the other end of their short position. And then the question came into like companies like Robinhood, which is marketed as being like an investment app for the single person, like myself, that I can go and I can buy and I can trade. But apparently the back end of Robinhood is these investment firms are buying the data, the independent trader data that so they can see what traders are doing and to get more insight into the market. So, and then Robinhood is apparently owned by the same company that owned or has big stakes in this investment firm. So there's a lot of like concern and concern of collusion and conspiracy going on as to who's right or wrong and who's is it, should people be going to jail for what's happened?
Actually, Bob, it's interesting. And before I answer this, I just want to make it clear, I haven't done a deep dive on this by any stretch.
Okay, yeah.
But one interesting thing to me is I think a lot of the irritation of the Robinhood investors was they were being limited from buying some of these positions in their accounts, if I'm not mistaken, or limited in quantities of buying. And what may have been happening, and I don't know about this, but what might have been happening is, if the same sort of back office or brokerage that's running Robinhood is the one that loaned the stock to the people who are short, and if those individuals and institutions that are short are trying to scramble to buy back stock and there's just not enough out there, then it'd be really hard to say, I need you to either close out your short position or post more capital, and then that person be unable to buy the stock if they say, I have no more capital, I need to close it out. So it's quite possible that one of the reasons that they were forced by regulators to limit the buying of your Robinhood investor who's going long the position might have been to sort of create room in the trade from a regulatory perspective to actually close out these short positions where there wasn't adequate margin for. Now, again, that's full-on speculation there. Mm-hmm. It's funny, I'm a huge fan of Michael Lewis. I don't know if listeners to the podcast have read any of his books, but he was the fellow that he started with a book called Liar's Poker years ago about the greed on Wall Street, and has a great book called The Big Short, which became a movie, and he wrote The Blind Side and a number of others. But I was joking with people that I can't wait for Michael Lewis's book to come out about what's been going on behind the scenes with all of this sort of Reddit and Robinhood and GameStop and what have you.
To actually figure out what's going on. Now, Reddit's moved on. They've gone on to silver, and they're talking about other stocks that haven't had the same effect that they did with. They really hit the home run with GameStop. I guess, like, do you see? Are you on Team Reddit, or are you on Team like VC investor? Like, who's, because there's talk too that what the Reddit guys were doing, investors were doing, was potentially going to cause another economic downturn if they were to cause a bubble or to pop, or is that okay, or is the investment world in some ways still the Wild West where people can get together like that, can make a plan and can execute?
I guess a few thoughts there. First of all, and one thing I will mention, you mentioned silver and then moving on to other things. And I just want to address one other thing about the mechanics of it. Then I will come back to whether or not I'm on Team Reddit. But so first thing is, the perfect security to do a pump and dump on is one that's thinly traded and doesn't have a lot of liquidity, because then every marginal dollar coming in creates more, if there just isn't many sellers, because it's a small company, not a big company, not a lot of stock out there, then the incremental dollars move the share price further. So in Reddit's case, it went from $6 a share to 600, and now it's well below $100 again. When the Reddit group, or whatever you want to call it, targeted silver, well, silver is a much broader market, with a lot more depth. You're talking billions and billions of market cap that are invested in various different types of silver, either the commodity or securities designed for you to access the commodity. So it was a lot more of a blip or a speed bump. It was kind of news in silver for the day, but silver certainly didn't go up by 600-fold or 100-fold or whatever it was, and then down again. Nokia also hit the radar, I believe, of the Reddit group. And Nokia was a much smaller move and for a shorter period of time. Now, circling back, so that's just kind of bringing you up to speed on what's been going on with Reddit. They do continue to target different companies, but the reason some of those first ones were so successful was they were little known, thinly traded companies with fairly small floats, and you add on the rocket fuel of a big short position that people have to start closing out, which incrementally adds to the buying. Now, as far as whether I'm on Team Reddit or not, all of this, like the traditional pump and dump, is it's certainly unethical, immoral, and illegal, mostly in terms of securities laws, depending on what you know and who you're telling people and when you're selling. And regardless of the legality of it, which can vary by jurisdiction and who actually knows what, the idea of promoting a security that that's junk, like that, that's why these companies have the biggest short positions, because most analysts believe they're not worth anything. The idea of trying to promote them, drive them up, and then if you're the person that started it and you're selling first, then that's just wrong, because it's kind of the greater fool theory. The people that initially bought Reddit at $6 or $10 or $50 didn't lose money even if they didn't sell. They would have rode it all the way up to 600 and back down to where it is. People that lost money were all the people calling us once GameStop was already in the news, who were buying it at $550 and $600 a share. And there's just no fundamental underpinning for why you'd put that kind of money in the company. Mm-hmm. Now, all that said, so the morality of it aside, I just don't think it's a smart way to invest, based on rumor, innuendo, and who can do the best job of getting a story out on social media about what company is the hot one today. Ultimately, Warren Buffett said it best, in my opinion. He said that in the short term, the market is a voting machine, and in the long term, the market's a weighing machine. And what he meant by that is, in the short term, the stock price really has no correlation with the value of the business. It's all about excitement around the stock, news, and supply and demand. And you're voting with your money. And in order to have that vote, you don't have to demonstrate emotional stability, intelligence, rational thinking, or anything like that. This Reddit case is a great example. People were voting by buying, and they weren't voting based on anything to do with the company. And anything that can go up by, tenfold in 2 days can come down by tenfold in 2 days. Now, to Warren Buffett's point, though, about long-term, the market's a weighing machine, what you'll see time and time again when you study the history of markets is, even though the day-to-day stock price movements of a company are not necessarily correlated with the underlying growth of the business, if you stretch it out and look at it over 5, 10, 20, 30 years, if you went to an example like Coca-Cola, the long-term growth of the stock price tends to mirror the long-term underlying growth of the business. And if Coca-Cola has grown by 17% a year for 30 or 40 years, the stock price inevitably will have grown by a rate remarkably close to 17% a year over 45 years, reflecting the growth of the business. And that's really, to me, the difference between investing and speculation. Now, if you like to mess around in the markets for fun and try and buy at 10 a.m. and sell at 4 p.m. and follow what's going on social media, then more power to you, and you're not hurting anyone or yourself. But if you're talking about your life savings and you're trying to generate solid returns over the long term, then it's really important to identify value in the companies that you're purchasing and to be prepared to hold them for that 3, 5, 10-year horizon for that weighing machine to take effect.
Yeah, and when this whole Reddit thing was going on and this investment group, I had talking with colleagues, talking with clients, talking with friends, and the comment came up about people thinking about, should I buy, or maybe I should go buy some of the GameStop to try to take it. And my thought too was just like, this is I feel like the opportunity had already the ship had sailed. If you were one of those people on that Reddit thread that they were making this plan, making this move, that's the time to potentially get in on something like that. But if you're already hearing about it in the news, it's already old news, and the chances for huge gains have already diminished, and the chances for huge losses are just going up. And my luck, I would be the guy that would be, I would have bought at the peak and I'd have sold at the bottom and I'd have made nothing. And so it was fun to watch. It was just fun to talk about. It was definitely, the hot topic for a few days there. But
actually, Bob, that reminds me, I want to share a saying with you that I ran across years ago. And this isn't so much a comment on the Reddit people, because like I say, I'm not prepared to pass judgment one way or another because I don't know enough about it. But this would be the comment to you had you bought it when it's already all over the news. So the saying is that what wise men do in the beginning, fools do in the end. And to your point, I was starting to get texts from kids of clients who are 20 years old, who have to pay tuition next year and have no money, asking me if they should put $500 into Reddit because they heard about it on their social media feeds. By the time your taxi driver is telling you about it, your children are telling you about it, and your mom is telling you about it, that's probably not the time you want to be buying. Best opportunities in the markets, it's like you want to go to the quiet fishing hole where nobody else is there. It's ignored, and you don't follow the frenzy and behave like a lemming for long-term success in financial markets.
And that's the hardest thing about it, because we all want the big rush. We want to feel like we're pulling the wheel. We want to see the sevens line up, and we want that. And in so many parts of our life, that's what we kind of go after. But I think
if you and your clients want to do that, you should go to Vegas.
Right? Like, why even bother with a brokerage? Yeah, just go put it all on black. But
get free drinks in the casino while you do it.
Yeah, well,
I guess although Vegas isn't an option right now. And no, joking aside, I think one of the things, and I'm not saying anything that you or your clients wouldn't already know, but I think one of the things that's really contributed to this is that to some degree, particularly for a lot of maybe millennials that don't have a lot of experience investing, but do have a lot of experience on social media. There's a lot of people with a lot of time on their hands where the stock market is like the new video game today. And, that's, again, we want to bring an institutional approach to retail investing, not a recreational approach to investing. So we're steering away from those sectors.
Well, I just touching back on the SPACs. The SPAC sounds like a much more, like you say, institutional and wise investment opportunity, even though there still is some risk, as opposed to trying to follow a Reddit thread and make my choices based on that. Hey, Rob, we're actually touching on 40 minutes, just a little bit over 40 minutes right now, which is fantastic. I think this has been a lot of great information. Is there anything else you wanted to kind of touch on before we kind of wrap this up for the day?
Just maybe a couple things in closing. One is to thank you again for allowing me the opportunity to catch up on my numbers a bit here on your podcast series. But I'm truly grateful for the opportunity to chat with you and your clients and to share a few thoughts and ideas. The other thing that I would mention, as you know, Bob, is we do specialize with dental clients and deal with a number of them. I believe we've got a really effective combination that we can deliver of effective investment management solutions, but doing that in concert with overall strategic thinking, wealth planning, tax mitigation. And so I'd love to talk to your clients if they're looking for a second opinion on anything they're doing, or if anything we've talked about here today has sort of piqued their curiosity in terms of our wealth management strategies.
Absolutely. And
perhaps I'll share my email. The best way to reach me, if anyone would like to, my email is rob.campbell@richardsonwealth.com. That's rob.campbell@richardsonwealth.com. And failing that, just Bob and I are in regular contact. So track me down through him or Bobby. I expect you'll include the email address in the show notes.
Yeah, absolutely. So this is going out a number of ways. I'm sending the video out to my clients directly. So that will, in the body of the email, will have your full title. It'll have again, phone number, contact information, email, and then again in the show notes for the podcast, I'll include the link for your email and other information as well. So no, yeah, definitely. If any questions, and again, people listening, reach out to me and I can definitely direct you to Rob, or again, his contact information will be available. So just go straight to him as well. Rob, we've got some other ideas for future conversations to have. I think that's exciting. I'm looking forward to that. And I think it's just, again, 2021, I think a lot of people are seeing as not really a recovery year yet in regards to how our business and our economies are going. I think we're trying to basically, patch the holes, stop the bleeding, kind of, get on the mend, get through it. And I think really people are looking already to 2022 as being a bounce back year on the economic side of things. I was happy for me to hear that, the investment opportunities are already recovering and there's opportunity there. So that's definitely good for you and your clients. And yeah, again, thank you for doing this. I always do appreciate talking to you. Your insight is expert on this in this realm, and so I'm always learning stuff, which is great. Learning just enough to get myself in trouble, maybe, or at least hopefully avoid the major blunders. But hey, thank you so much. Again, I hope you and your family are doing well in this kind of strange and weird time. And yeah, let's get you back on here in a couple of weeks or a month or so and continue this conversation. And everyone listening, hey, thank you so much. And we will talk to you guys soon. So bye for now, and we'll catch up soon.
Awesome. Thanks, Bob. I look forward to it. And thanks to your guests or your listeners.
Okay, buddy. Bye for now.